In this video, you're going to learn the absolute basics of accounting, the foundation that everything else is built on. And here's the truth. If you don't understand these basics, accounting will always feel confusing, overwhelming, and frustrating. But if you do get them, suddenly everything starts to make sense. That's why I created this full course, to make accounting clear, simple, and actually enjoyable. Step by step, in plain language, no jargon. I promise by the end of this video, you'll not only understand accounting, you'll feel confident using it. And if you want even more support, I've added extra resources for you down in the description. So stick with me, because this video is the key to finally unlocking accounting the right way. Accounting is often called the language of business, but what does that really mean? At its core, accounting is the process of identifying, recording, summarizing, and reporting the financial activities of a business to help interested users make informed decisions. In simple words, it's how we keep track of money, where it comes from, where it goes, and what it means for the future of a business. Some people describe accounting as a system for telling the financial story of an organization. Others call it a decision-making tool because it turns numbers into information that people can actually use. And that's the beauty of it. Accounting is not just math, it's communication. So why do we need it? Because accounting helps us measure performance, see whether a business is making profit or loss, and guide important decisions. Without it, running a business would be like driving in the dark without headlights. You're moving, but you don't know where you're going. Now, who actually uses this information? There are two big groups of users: internal users and external users. Internal users are people inside the company, like managers and employees. They use accounting information to make day-to-day decisions. How much inventory should we order? Can we afford to hire another worker? Are we staying within our budget this month? External users are people outside the company, like investors, creditors, regulators, and tax authorities. They're not running the business, but they need financial information to decide things like, should I invest in this company? Is it safe to lend them money? Are they paying the right amount of taxes? Here's a simple example. Imagine you run a small coffee shop. As the manager, you might look at sales numbers to decide if you need an extra barista during busy mornings. That's internal use. But at the same time, an investor might look at your financial reports to decide if your coffee shop is worth investing in. That's external use. So in short, accounting records what happens, turns it into clear financial information, and delivers it to the people who need it, inside and outside the business. That's why it's the language of business no matter which country you're in. When we talk about accounting, the first big question is this: how do we make sure the numbers are fair, reliable, and useful? Imagine every company just recording money however they wanted. One company might guess. Another might exaggerate. Another might record today's market prices instead of what they actually paid. If that were the case, comparing two businesses would be impossible. And that's why accounting principles and assumptions exist. They act like the rules of the game, making financial information consistent, comparable, and trustworthy. Now, across the world, two main frameworks guide these rules. In the United States, it's GAAP, which stands for Generally Accepted Accounting Principles. But in more than 140 countries, it's IFRS, the International Financial Reporting Standards. They aren't identical in every detail, but the foundations, the assumptions and principles we're about to go through are shared worldwide. Let's begin with the assumptions. The first assumption is the economic entity assumption. This simply means the business is treated as separate from its owners. If you run a bakery, the bakery's money is not your personal bank account. Buying groceries for your home has nothing to do with recording flour for your bakery. Keeping them separate avoids confusion and keeps the financial picture of the business clean. The second assumption is the monetary unit assumption. Accounting only records things that can be measured in money, and it records them in a stable currency. If you buy flour for $500, That's what goes into the records. We don't record things like employee happiness or the value of your reputation, because those can't be measured in money in a reliable way. The third is the time period assumption. Businesses are ongoing, but we break their life into chunks of time, months, quarters, or years, so we can measure performance. That's why financial statements always have dates, like for the year ended December 31st. Without this, you'd have no way to compare last year's results with this year's. The fourth is the going concern assumption. Unless there's clear evidence that a company is shutting down, we assume it will continue into the foreseeable future. This matters because if you assumed a company was closing tomorrow, you'd have to value all its assets at liquidation prices, which would give a very different picture. And finally, the accrual basis assumption. This one is crucial. It says we record revenues when they are earned and expenses when they are incurred, not just when cash changes hands. Imagine you run a coffee shop and sell a coffee on credit today. You don't wait until next week, when the customer finally pays, to record it as revenue. You record it today, because that's when the earning actually happened. Those are the 5 assumptions. Now let's move into the guiding principles. The first is the historical cost principle. Assets are recorded at their purchase price, not what you think they're worth now. If you buy a laptop for $1,200, it stays recorded at that amount. Even if the market value changes, the books reflect the original cost, because that figure is objective and verifiable. Next, the revenue recognition principle. This tells us that revenue is recorded when it's earned, not when cash arrives. If you complete a project today but your client pays you next month, the revenue still belongs to today because that's when you delivered the service. The matching principle works hand in hand with revenue. It says that expenses must be recorded in the same period as the revenues they help to generate. Let's say you sell 100 cakes in March. The cost of ingredients and labor for those cakes should also be recorded in March, not in April when you pay the supplier, so the profit shown for March is accurate. Then we have the full disclosure principle. Financial statements should tell the whole story. If there are important details investors or creditors need to know, such as pending lawsuits or unusual accounting policies, the company must disclose them in notes attached to the statements. Transparency builds trust. The objectivity principle reminds us that accounting numbers must be based on evidence, not personal opinion. If you buy land, you record the actual purchase price shown in the contract, not what you feel the land is worth. The consistency principle is about stability. A company should use the same accounting methods from one period to the next, unless there's a valid reason to change, and if they do change, they must clearly explain it. This makes it possible to compare results over time. Then comes the conservatism principle, sometimes called prudence. When in doubt, accountants should avoid overstating assets or income. If there's a chance that a customer might not pay, it's safer to record it as a possible loss early. The goal is not to make the company look worse than it is, but to avoid painting an overly optimistic picture that could mislead users. Next is the materiality principle. Not every small detail needs to be tracked with equal weight. If your business spends $5 on pens, you don't need to create a special account for it. But if you spend $50,000 on new equipment, that's material. It's significant enough to matter for decision-making, so it must be clearly recorded. The reliability principle emphasizes that information must be verifiable. Transactions should be backed up by receipts, invoices, or contracts. Reliable evidence is what separates proper accounting from guesswork. And finally, the industry practice principle. Certain industries like banking, agriculture, or oil and gas may have special accounting practices that fit their unique needs. As long as they're consistently applied and disclosed, they're accepted. So let's bring it all together. These assumptions and principles are what make accounting the same language across the globe. They make sure reports are clear, comparable, and fair. They help investors decide whether to invest, creditors decide whether to lend, and managers decide how to run the business. Without them, financial information would be just random numbers. But with them, accounting becomes a trusted system for decision-making everywhere. Every subject in accounting, no matter how advanced it gets, is built on one simple formula. We call it the accounting equation, and it looks like this: assets equals liabilities plus equity. Now, that might sound abstract at first, but it's actually very logical once you see how it works. Think of it as the foundation, the bedrock of accounting. Every single transaction a business makes will affect this equation, and it must always stay in balance. So, let's break it down. First, assets. These are simply what the business owns. It could be cash in the bank, equipment like laptops and machines, buildings, or even inventory sitting on shelves, ready to be sold. Assets are the resources a company uses to operate and, hopefully, to make a profit. Next, liabilities. These are what the business owes: loans from a bank, unpaid bills to suppliers, wages owed to employees. All of these are obligations the company must settle in the future. Liabilities are essentially claims that outsiders have on the company's resources. And finally, equity. This is what belongs to the owners. You can think of it as the residual interest, what's left for the owners after the company pays off its liabilities. Equity includes the money that owners originally invested, plus retained earnings, which is profit that the company has kept instead of paying out as dividends. Now here's the key idea. Everything the company owns has to be financed somehow. If you see a piece of equipment in a business, that equipment was either purchased with money borrowed from creditors, that's a liability, or with money invested by the owners. That's equity. There's no other option, and that's exactly why the equation, assets equals liabilities plus equity, always balances. Let's walk through a simple example. Suppose you start a small business with $5,000 of your own savings. You put that money straight into the business bank account. What happens? The business now has an asset, cash of $5,000. On the other side of the equation, equity is also $5,000 because that's the owner's contribution. Liabilities are zero because you haven't borrowed anything. So, assets equal liabilities plus equity. 5,000 equals 0 plus 5,000. Perfectly balanced. Now let's make it slightly more interesting. Imagine the business takes out a $2,000 loan from the bank. Assets increase because cash goes up by $2,000, but at the same time, liabilities increase by $2,000 because now you owe the bank. Notice that the equation is still balanced. You gained more assets, but they were financed by a new liability. Finally, picture that you use $3,000 of your cash to buy equipment. In this case, one asset goes down. Cash decreases, but another asset goes up. Equipment increases. Overall, total assets don't change, and the equation stays balanced. This balancing act is not optional. It's the golden rule of accounting. Every transaction, no matter how small or complex, must keep the equation in balance. That's why, in double-entry bookkeeping, we always record at least two sides to every transaction. If something goes up on one side, something must go down or increase on the other. And here's something important to remember. The accounting equation is not just theory. It directly shapes the structure of the balance sheet, one of the most important financial statements. The balance sheet is literally built on this equation, with assets on one side and liabilities plus equity on the other. That's why it's called a balance sheet, because by definition it always balances. So, to recap, assets are resources the business owns, liabilities are what it owes, and equity is the owner's share. Together, they must always fit into the equation. Assets equals liabilities plus equity. This simple relationship is what keeps accounting consistent and reliable. Now that you understand the accounting equation, let's bring it to life. Because in reality, accounting is nothing more than a story of transactions, and transactions are the heartbeat of accounting. Every time money moves, every time a promise is made, every time value is created or exchanged, that's a transaction. And each one, no matter how small, reshapes the accounting equation. Now, here's where things get interesting. The business earns revenue. Suppose you provide a service and a customer pays you $500 in cash. What changes? Cash, which is an asset, increases by 500. On the other side of the equation, equity increases because revenue ultimately increases retained earnings, and retained earnings are part of equity. So, revenue boosts the owner's claim on the business. But of course, businesses also have expenses. Let's say you pay $200 in salary to an employee. Cash decreases by 200, lowering assets. At the same time, equity decreases by 200 because expenses reduce retained earnings. Expenses are the opposite of revenue. They shrink equity. And once again, the equation stays balanced. If you were to track these events in a simple table, you would see the accounting equation update in real time. Assets shift up and down. Liabilities change when you borrow or repay, and equity moves with investments, revenues, and expenses. But at every step, no matter what happens, the left side equals the right side. That's the beauty of double entry accounting. And here's something crucial to remember. Every single transaction always has at least two sides. One account goes up, another goes down, or one goes up on each side of the equation. There is never just one change. That's why accounting records are called double entry bookkeeping. Every debit has a credit, every movement has a counter movement, and the books always balance. So, to put it all together, transactions are the DNA of accounting. They are the raw events that flow into the accounting system, shape the financial statements, and ultimately tell the story of a business. And as long as you understand how each transaction fits into the equation, you'll never be lost in accounting. Up to now, we've been talking about transactions, the everyday events that change a company's financial position. Transactions are the heartbeat of accounting. But here's the challenge. If businesses have dozens, hundreds, even thousands of transactions happening every single day, how do we keep track of them in a way that's clear, organized, and never out of balance? That's where the recording process comes in. Think of it as the accounting system's filing cabinet. Every transaction is captured, sorted, and placed exactly where it belongs, so that when we prepare financial statements later, nothing is missing and everything makes sense. And here's the interesting part. No matter where you are in the world, whether a company follows GAAP in the United States or IFRS in more than 140 countries worldwide, the recording logic is exactly the same. The tools, the steps, the way we use debits and credits, it's universal. So, as we dive in, remember this. Recording isn't just paperwork. It's the backbone of financial reporting. It's what keeps the numbers reliable, comparable, and trustworthy. Without this process, accounting would just be chaos. But with it, you can turn endless transactions into a crystal clear financial picture. All right, here's the part every beginner worries about: debits and credits. Most students hear those words and immediately think, oh no, this must be complicated. But here's the truth. Once you see the logic behind it, you'll realize it's actually very simple, and it's the foundation of all accounting. Let's start with the big idea. Every single transaction affects at least two accounts, always. Why? Because the accounting equation, assets equals liabilities plus equity, has to stay balanced. If something changes on one side, something else must change on the other. That's why accounting uses what we call the double entry system. For every debit, there must be an equal credit. The total debits will always equal the total credits. Now, before we go further, let's clear up a common misunderstanding. Debit does not mean good, and credit does not mean bad. This isn't your bank account statement. In accounting, debit and credit are simply directions. Debit means the left side of an account, and credit means the right side. That's it. Nothing scary about it. To keep this organized, accountants use something called a T account. Imagine drawing a big letter T. On the left side of the T, you have debits. On the right side, you have credits. Every account in accounting, whether it's cash, equipment, salaries, or revenue, can be shown in this T account format. So, how do debits and credits actually affect different accounts? Here's the pattern. Assets, like cash, equipment, and supplies, increase on the debit side and decrease on the credit side. Liabilities, like loans or accounts payable, do the opposite. They increase with credits and decrease with debits. Equity, which represents the owner's claims, also increases with credits and decreases with debits. Then we have revenues. Revenues increase equity, so they increase with credits. And finally, expenses. Expenses reduce equity, so they increase with debits. If that feels like a lot to memorize, here's a helpful way to picture it. Imagine cash. When you receive money, your cash account goes up, and that's a debit. But when you pay out money, cash goes down, and that's a credit. Now flip to the liability side. When you take out a loan, your debt goes up, and that's a credit. When you repay the loan, liability goes down, and that's a debit. The beautiful thing is, once you understand this pattern, it never changes. Assets are always debit increase, credit decrease. Liabilities and equity are always credit increase, debit decrease. Revenues and expenses just follow the same logic because they flow into equity. Let's test this with a quick real-world example. Imagine you own a coffee shop and a customer pays you $100 in cash for drinks. What happens? Cash, which is an asset, goes up, so you debit cash $100. Revenue also goes up, and revenue increases with credits, so you credit revenue $100. Balanced. Debits equals credits. Now imagine you pay $40 for supplies. Supplies, an asset, go up, so debit supplies $40. Cash goes down, so credit cash $40. Balanced again. Notice what's happening? Every transaction has two sides. One account is debited, another is credited. They're equal, they're balanced, and that's why the system works. And here's one last thing students often forget. This debit and credit framework is universal. Whether you're in the US, Europe, Asia, or anywhere else, the double entry system is the same. GAAP or IFRS, it doesn't matter. Debits are always left, credits are always right, and debits must always equal credits. That consistency is what makes accounting the reliable language of business worldwide. By the way, don't forget to check the links in the description. I've put together some extra resources there that will really help you understand accounting even faster and apply it in real life. And the best part, there's also a free guide waiting for you, so make sure you grab that before you move on. By the way, don't forget to check the links in the description. I've put together some extra resources there that will really help you understand accounting even faster and apply it in real life. And the best part, there's also a free guide waiting for you, so make sure you grab that before you move on. Now that we've talked about debits and credits, let's actually see how accountants organize this information. And for that, we use something called a T account. Why the name? Because it literally looks like the letter T. Picture this. You draw one straight line across the top and one straight line down the middle. On the left side, you write debits. On the right side, you write credits. Simple as that. Every account a business uses, whether it's cash, supplies, salaries, or revenue, can be represented by one of these T accounts. They're like little containers that keep track of increases and decreases. Let's start with an easy one. Cash. Cash is an asset. And remember, assets increase with debits and decrease with credits. So whenever money comes in, we record it on the left side of the T account. Whenever money goes out, we record it on the right side. For example, if your coffee shop receives $500 from customers, we debit cash $500. Left side. If you pay $200 for rent, we credit cash $200. Right side. At any point, you can look at the T account, add up the left side, subtract the right side, and see how much cash is left. That's why T accounts are so helpful. They give you a running balance. Now, let's look at an expense account, like salary expense. Expenses increase with debits, which means the left side of the T account is where we track them. So every time you pay your employees, that amount gets recorded as a debit to salary expense. The credit side of that account usually stays empty because expenses almost always build up on the debit side. Revenues work the opposite way. For something like sales revenue, credits increase the account. So every time you make a sale, the revenue T account gets filled in on the right side. And here's the cool part. Once you start practicing with these T accounts, the logic clicks. You can instantly see whether an account normally grows on the left or on the right. Assets and expenses build on the debit side. Liabilities, equity, and revenues build on the credit side. Think of T accounts like the training wheels of accounting. They're not the final report, but they're an incredibly useful tool to visualize the flow of transactions. Later, when we post journal entries into a ledger, the T accounts are what help us organize and check that everything is balanced before we move on. So whenever you feel confused, just draw that big letter T on paper, label debit on the left, credit on the right, and start recording. It's one of the simplest, clearest ways to really understand what's happening in the system. All right, now that you're comfortable with transactions and T accounts, it's time to connect the dots into what accountants call the accounting cycle. Think of this cycle like a pipeline. A transaction happens in the real world. Someone pays you, you buy supplies, you take out a loan. And that transaction has to flow through the system in an organized way so that at the end of the month or at the end of the year, we can produce financial statements that tell the story of the business. The first stage in this pipeline is the journal. The journal is sometimes called the book of original entry. Why? Because every transaction is recorded here first, in the exact order it happens, just like writing in a diary. Each entry shows the date, the accounts affected, the debit and credit amounts, and a short explanation. For example, let's say your coffee shop buys $1,000 worth of equipment in cash. In the journal, you would record debit equipment $1,000, credit cash $1,000. That way, the very first record of that transaction is preserved in chronological order. But if we only kept track of transactions in the journal, it would get messy fast. Imagine flipping through pages and pages just to see how much cash you have left. That's why we have the second stage, the ledger. The ledger is where we take those journal entries and reorganize them by account instead of by date. Think of the ledger as the filing cabinet of accounting. Every account, cash, accounts payable, revenue, salaries, has its own page or section. When we post from the journal to the ledger, we're basically updating those individual files. So now, if you want to see the cash balance, you don't have to dig through all the transactions. You just open the cash account in the ledger and check the running total. Once everything is posted to the ledger, we can move to stage 3, the trial balance. This is simply a list of all the accounts in the ledger with their ending balances. On one side, we list total debits, and on the other side, we list total credits. If everything has been recorded correctly, those two totals should be equal. Debits must equal credits, always. The trial balance is like a checkpoint. It doesn't guarantee that every transaction was recorded in the right account, but it does tell you whether the math works. If your debits and credits don't match here, you know something went wrong in the process, and you have to go back and find the error. So to recap, here's the flow so far. Journal is the diary of transactions, chronological. Ledger is the filing cabinet, organized by account. Trial balance is the checkpoint, making sure debits and credits balance. And here's a sneak peek. From the trial balance, the accounting cycle continues with adjusting entries, financial statements, closing entries, and even a post-closing trial balance. But don't worry, for now we're focusing just on these first steps, because this foundation is what everything else is built on. Think of it this way: transactions are the heartbeat of accounting, and the journal, ledger, and trial balance are the circulation system that keeps that heartbeat flowing through the body of financial information. Now, let's bring this to life with a simple example. Imagine you've just opened a small coffee shop, and we're going to follow your first week of transactions. Each day something happens, and we'll record it step by step. Day 1. The business begins. You invest $5,000 of your own savings into the coffee shop. The journal entry is debit cash $5,000, credit owner's equity $5,000. What does that mean? Cash increases because the business now has money in the bank, and equity increases because the owner has a claim on that money. When we post this to the ledger, we see the cash account increase by $5,000, and the equity account also show $5,000. Day 2. Taking out a loan. The next day, the business borrows $2,000 from the bank. The journal entry is debit cash $2,000, credit bank loan payable $2,000. Cash increases again because we received money, but at the same time, a liability is created, bank loan payable, showing that we owe the bank. In the ledger, cash is now $7,000 total, and loan payable shows $2,000. Day 3. Buying equipment. Now you buy a coffee machine for $1,200, and you pay in cash. The journal entry is debit equipment $1,200, credit cash $1,200. Here's the key idea. Total assets haven't changed. We simply converted cash into equipment. In the ledger, cash goes down to $5,800, and a new equipment account appears with $1,200. Day 4. Earning revenue. On Thursday, customers come in and you earn $500 in cash sales. The journal entry is debit cash $500, credit revenue $500. Cash goes up again, now totaling $6,300. Revenue increases by $500, which ultimately increases equity because revenues boost the owner's claim on the business. Day 5. Paying salaries. Finally, you pay $200 to an employee for their week's work. The journal entry is debit salaries expense $200, credit cash $200. Here, cash decreases to $6,100, and we record an expense. Remember, expenses reduce equity because they're the costs of doing business. Now, at the end of the week, we take all these journal entries and post them to the ledger. In the ledger, each account has its own page. The cash account shows every increase and decrease across the week. Plus 5,000, plus 2,000, minus 1,200, plus 500, minus 200. When you total those movements, the cash account balance is $6,100. In the ledger, you'll also see equipment with $1,200, bank loan payable with $2,000, owner's equity with $5,000, revenue with $500, salaries expense with $200. Now we're ready for the trial balance. This is simply a list of every account and its ending balance. So we would list cash, debit $6,100, equipment, debit $1,200, salaries expense, debit $200, bank loan payable, credit $2,000, owner's equity, credit $5,000, revenue, credit $500. When we add up all the debits, we get $7,500. When we add up all the credits, we also get $7,500. And that's the beauty of double entry accounting. The system balances. What's important to notice is not just that the math works, but also that the trial balance is a stepping stone. From here, accountants can move forward to adjustments, then to preparing the financial statements. But without this clear process, journal to ledger to trial balance, we would never have reliable numbers to work with. So, in just 1 week of a coffee shop's life, you've already seen the full flow of accounting. Transactions recorded in the journal, organized into the ledger, and summarized in the trial balance, always with debits equaling credits. This is the foundation that every accountant in the world, whether under GAAP in the United States or IFRS internationally, relies on. So now let's pause and step back. What we've just walked through, recording transactions in the journal, posting them to the ledger, and checking them with a trial balance, is the backbone of accounting. Without this recording process, everything else in accounting would fall apart. Financial statements, which investors and managers rely on, would be impossible. This system gives us accuracy. Every dollar in is tracked, every dollar out is tracked. It gives us consistency. Every transaction is treated the same way, and it gives us balance, because in double entry, debits always equal credits. That balance is what makes accounting reliable across the world. But here's something that often confuses beginners. Each account has what we call a normal balance. This simply means the side of the T account where increases are recorded. For assets and expenses, the normal balance is on the debit side. For liabilities, equity, and revenues, the normal balance is on the credit side. This little rule is a lifesaver because it keeps you from second-guessing whether an account should go up with a debit or a credit. Another key tool is the chart of accounts. Think of it as the dictionary of every account a business uses: cash, accounts receivable, salaries expense, revenue, and so on. Whenever you write a journal entry, you're pulling account names from this chart. It keeps things standardized so two accountants looking at the same company will always speak the same language. Now, I want you to see where we are in the bigger journey. The full accounting cycle begins with a transaction, like our coffee shop example. Then it flows through the journal, the ledger, and the trial balance. Next, we adjust the accounts for things like expenses that were earned but not yet paid, or revenue that's been earned but not yet recorded. After adjustments, we prepare the financial statements, the income statement, the balance sheet, and the statement of retained earnings. Then, finally, we close the temporary accounts, like revenues and expenses, to reset them for the next period. And at the very end, we prepare a post-closing trial balance to make sure everything is ready for the next cycle. So what we've learned here is just the first half of that cycle. But it's the most important half. Because without clean, accurate recording, the financial statements at the end won't mean anything. Think of it this way. If accounting is like building a house, then recording is the foundation. If the foundation is shaky, the whole structure is unstable. But if the recording process is solid, everything else, the adjustments, the statements, the closing, will stand strong. And that's why the journal, the ledger, and the trial balance are so powerful. They turn messy day-to-day transactions into organized, reliable information that anyone, anywhere in the world can understand and trust. Let's take a step forward in our accounting journey. So far, we've been recording transactions, posting them to the ledger, and preparing a trial balance. But here's the problem. If we stopped there, our numbers would often be misleading. Why? Because life doesn't always line up perfectly with the way cash moves. Think about it. Sometimes we pay for things in advance. Sometimes we owe money before we actually pay it. Sometimes customers pay us ahead of time, and sometimes we've earned revenue but haven't billed yet. If we only relied on cash moving in and out, our financial statements would never truly reflect what's happening in the business. That's why accountants use adjusting entries. Adjusting entries are small but powerful updates we make at the end of an accounting period, usually month-end or year-end, to make sure our books show the real financial position of the company. And the good news is, there are just a handful of main types you need to master. Once you understand them, the whole world of accrual accounting will make sense. There are 4 major categories of adjusting entries, plus one special case. Let's walk through them slowly with examples so you'll never forget. Number 1. Prepaid expenses. Cash first, expense later. Imagine you run a small business, and in January, you pay $6,000 upfront for 6 months of rent. If you recorded all $6,000 as rent expense in January, your January income statement would look awful. Way too much expense in 1 month. But if you ignore it, then your later months would look too profitable. Neither one tells the truth. Here's how we fix it. When you pay up front, we don't call it an expense yet. Instead, we record it as an asset called prepaid rent. Then, each month, as time passes and you use up that rent, we adjust it. So in January's adjusting entry, we take 1 month's worth, $1,000, and record debit rent expense $1,000, credit prepaid rent $1,000. That way, each month shows the correct expense and the asset gets smaller as you use it up. This principle applies not just to rent, but also insurance paid up front or supplies you bought in advance. Number 2, unearned revenues. Cash first, revenue later. Now let's flip the situation. Suppose you run a magazine company and a customer pays you $120 for a 1-year subscription. The cash comes in today? Great, but have you earned it yet? Not really. You still owe them 12 issues. So at first, we record the $120 as a liability called unearned revenue. Each month, as you deliver one magazine, you've earned 1/12 of the payment. So, at month end, we adjust by moving $10 from unearned revenue into revenue. The adjusting entry looks like this. Debit unearned revenue, $10. Credit service revenue, $10. This keeps your income statement honest. Without the adjustment, you'd be showing all $120 as revenue on day 1, which would make your January look amazing, but the rest of the year would look empty. Adjusting entries spread it out so it matches reality. Number 3, accrued expenses. Expense first, cash later. Now let's think about expenses that build up before we pay them. A classic example, salaries. Imagine it's the last day of the month. Your employees have worked, but payday is scheduled for next week, in the new month. If you wait until cash leaves your account, your income statement for this month will miss a big expense. That means your profit will look higher than it should. So what do? We record an adjusting entry to recognize the salary expense now, even though we haven't paid it yet. The entry would be debit salary expense, credit salaries payable. Then, when payday comes and you hand out the cash, you reduce the liability with another entry. This way, your books reflect reality. The company owes money to employees for work already done, and the expense is shown in the right period. Number 4, accrued revenues. Revenue first, cash later. This one is the flip side. Sometimes you earn revenue before the customer pays. Picture this. You run a small consulting business. At the end of March, you've finished a $2,000 project for a client. They love your work, but you don't send the invoice until April, and they won't pay until May. Should March show 0 revenue? Of course not. You've already earned it. So we make an adjusting entry in March. Debit accounts receivable $2,000, credit service revenue $2,000. Now, your income statement shows the $2,000 revenue in March, when it was earned, and your balance sheet shows that someone owes you money. Later, when the client pays, you reduce accounts receivable and increase cash. This prevents the financial statements from being delayed or distorted just because cash hasn't moved yet. Finally, let's talk about one adjustment that confuses almost every beginner: depreciation. Depreciation is about spreading the cost of a long-term asset, like a building, a truck, or even our coffee machine, over its useful life. Why? Because these assets give value over many periods, not just the day you buy them. Let's go back to our coffee shop example. Suppose you bought a $1,200 coffee machine, and it's expected to last 12 months. If you expense the full $1,200 in the first month, your books show a huge cost right away, even though the machine will keep serving customers for a whole year. Instead, we adjust each month to recognize just $100 of depreciation expense. The adjusting entry looks like this. Debit depreciation expense $100, credit accumulated depreciation $100. Notice something. We don't credit the machine account directly. we use a separate contra asset account called accumulated depreciation. This allows the balance sheet to show the original cost of the asset along with how much of its value has been used up so far. This way, financial statements stay realistic, expenses are matched to the periods they benefit, and assets don't just disappear from the books. So to recap, adjusting entries are like the fine-tuning stage of accounting. They make sure revenues and expenses fall in the right period regardless of when cash moves. Prepaid expenses, cash first, then expense as time passes. Unearned revenues, cash first, then revenue as service is provided. Accrued expenses, expense first, cash later. Accrued revenues, revenue first, cash later. And depreciation, spreading cost over time. Once you see these patterns, you'll start to notice them everywhere in business, from prepaid rent to salaries, subscriptions, service fees, and long-term assets. The big idea is this: adjusting entries bring accuracy and honesty to financial reporting. Without them, financial statements would constantly overstate or understate profits. With them, investors, managers, and regulators can actually trust the numbers. And that's the magic of adjustments. They keep accounting tied to reality. Let's put all of this theory into action with our coffee shop example. Up to now, we've been recording transactions. The owner invested cash, we borrowed a loan, we bought a coffee machine, made some sales, and paid salaries. At the end of the week, we prepared a trial balance, and everything balanced. Debits equaled credits. But here's the catch. Balancing doesn't mean everything is accurate yet. Some important things are missing, and that's exactly why we need adjusting entries. So let's walk through a few realistic adjustments together and see how they transform our trial balance. Suppose at the very beginning, our coffee shop paid $6,000 upfront for 6 months of rent. In our trial balance, that $6,000 is sitting in the account called prepaid rent, an asset. But the month has now ended. We've already used up 1 month of the space. If we don't adjust, the income statement will show 0 rent expense for the month, which makes it look like we got free rent, and that's not true. So here's what we do. We transfer $1,000 from the asset prepaid rent into rent expense. The adjusting entry is simple. Debit rent expense $1,000, credit prepaid rent $1,000. Now, when you look at the trial balance after adjustment, prepaid rent has dropped from $6,000 to $5,000, and rent expense now shows $1,000. Suddenly, the income statement tells the truth. The business really did use up $1,000 worth of rent this month. Next, let's talk about employees. Imagine that at the end of the month, 2 workers have earned $300 in wages that haven't been paid yet. If we don't adjust, our books show nothing. No salary expense, no liability. That means our profit looks bigger than it really is, and we're pretending we don't owe employees money. The adjustment fixes that. We record debit salaries expense, $300, credit salaries payable, $300. Now in the updated trial balance, we see salaries expense increased by $300. So profit is lower, but it's accurate. And on the balance sheet, a new liability called salaries payable appears, showing that we owe our employees. This tiny adjustment makes our books honest and complete. Finally, let's handle depreciation. Remember, we bought a $1,200 coffee machine, and it's expected to last 12 months. At the end of the first month, if we don't adjust, the machine still shows $1,200, and there's no expense for using it. That makes profits look higher than reality, because in truth, part of that machine's cost should be counted as an expense this month. So, we spread it out. We record 1 month of depreciation, debit depreciation expense, $100. Credit accumulated depreciation, $100. Now, the trial balance after adjustment looks different. Depreciation expense shows $100 on the income statement. And on the balance sheet, we see the equipment account still at $1,200, but right underneath it, accumulated depreciation of $100, leaving a net book value of $1,100. That way, we don't erase the machine from our books, but we clearly show how much of its cost has been used up. Now let's step back and compare. Before adjustments, the trial balance looked neat. Debits equaled credits, but it wasn't really accurate. Rent expense was zero, salaries expense was too low, and depreciation wasn't recognized at all. The income statement looked like we had more profit than we truly did. After adjustments, the picture is much clearer. Rent expense is showing $1,000, salaries expense shows $300, and depreciation expense shows $100. Net income is lower, but this time it's honest. On the balance sheet, assets like prepaid rent and equipment are adjusted correctly, and liabilities like salaries payable are shown. This is the real power of adjusting entries. They don't just move numbers around. They make sure that financial statements reflect reality, not just cash movement. So to wrap up, prepaid expenses remind us to move costs from assets to expenses as time passes. Accrued expenses make sure obligations like salaries are shown even before we pay. Depreciation ensures long-term assets are spread fairly across their useful lives. By walking through these adjustments, we've transformed a simple trial balance into something much more reliable, something investors, managers, or even the owner of the coffee shop can actually use to make decisions. And that's why adjusting entries aren't just bookkeeping details. They're the bridge that connects raw transaction data to meaningful financial statements. By the way, don't forget to check the links in the description. I've put together some extra resources there that will really help you understand accounting even faster and apply it in real life. And the best part, there's also a free guide waiting for you, so make sure you grab that before you move on. Now that we've seen how adjustments make the trial balance accurate, it's time to finish the cycle by learning how accountants close the books. And trust me, this step is just as important because it resets the stage for the next accounting period and keeps financial records clean and organized. Let's start with the big picture. In accounting, not all accounts are treated the same way. Some accounts are what we call permanent accounts, and others are temporary accounts. Permanent accounts are the ones that carry forward from year to year. Think of assets, liabilities, and equity. If you have $2,000 of cash at the end of December, that same $2,000 shows up as your starting cash balance in January. These accounts don't reset, they continue to build on themselves over time. Temporary accounts, on the other hand, are different. These include revenues, expenses, and dividends. They represent activity for just one period. For example, sales you earned in January belong to January only, not to February or March. Salaries expense for this month belongs to this month alone, and dividends paid to shareholders are also tied to that specific period. If we left these balances sitting around, they would just pile up and mix together with future months or years, which would make it impossible to measure performance accurately. That's why at the end of each accounting period, usually at the end of the month, quarter, or year, we close temporary accounts and reset them back to zero so the new period starts fresh. So, how do we actually do that? Let's walk through the closing process step by step. The first step is to close all revenue accounts into something called the income summary account. Imagine our coffee shop earned $10,000 in revenue during the month. On the books, that $10,000 is sitting in the revenue account as a credit balance. To close it, we make a journal entry that debits revenue $10,000 and credits income summary $10,000. The revenue account now has zero, and the amount has been transferred to income summary. Next, we close all expense accounts. Let's say our expenses for the month add up to $7,000, including rent, salaries, and depreciation. Expenses normally carry debit balances, so to close them, we do the opposite. We credit each expense account for its balance and debit income summary for the total of $7,000. Just like that, all the expense accounts are reset to zero, and their total is sitting inside income summary. Now the income summary account is showing the difference between revenues and expenses. In other words, net income. In our example, we had $10,000 of revenue and $7,000 of expenses, leaving a net income of $3,000. That's exactly what income summary shows. The third step is to close the balance in income summary to retained earnings, which is part of equity. If there's net income, like our $3,000, we debit income summary and credit retained earnings for $3,000. If there had been a net loss instead, the entry would go the other way. After this step, income summary is zero and retained earnings has increased by the month's profit. Finally, the fourth step is to close out dividends. Remember, dividends represent distributions of earnings back to the owners, and they also need to reset each period. Let's say we declared $1,000 in dividends this month. The dividends account has a debit balance of $1,000. To close it, we credit dividends $1,000 and debit retained earnings $1,000. That reduces equity slightly, reflecting the payout to shareholders. So let's recap with the numbers. We started with $10,000 in revenue and $7,000 in expenses, giving us a net income of $3,000. That $3,000 was transferred into retained earnings. Then we closed out $1,000 of dividends, reducing retained earnings to a net increase of $2,000. And now all the revenue, expense, and dividend accounts are sitting at zero, ready to begin recording fresh activity for the new period. The beauty of this system is that it keeps performance neatly separated. Each period has its own clean income statement. If you look at January, you see only January's revenues and expenses. If you look at February, you see only February's. Nothing is muddled together. Meanwhile, the permanent accounts, cash, equipment, loans, retained earnings continue to carry forward, showing the company's ongoing financial position. You can think of closing entries like wiping a whiteboard clean at the end of class. You don't throw away the board itself. That's like your permanent accounts. But you erase the notes so you can start fresh with the next lesson. Without this process, accounting records would become messy and it would be nearly impossible to measure performance period by period. So by the end of the closing process, the income statement accounts have been reset, the dividends account has been cleared, and the balance sheet is updated with the new ending equity. And just like that, the books are officially closed for the period and the accounting cycle is complete, at least until the new period begins. So let's step back for a moment and see the bigger picture. We've covered a lot in this section, adjustments and closings, but why do they really matter? Think of adjustments as fine-tuning. Every month, every quarter, before we finalize the books, we stop and make sure all the numbers reflect reality. Did we use up some prepaid rent? Did employees earn salaries that haven't been paid yet? Did our equipment lose a bit of value through use? These adjustments make sure our financial records are not just numbers, but an accurate reflection of the business at that moment in time. Without them, financial statements would be misleading, like a blurry photograph that doesn't show the true picture. And then comes closing, the reset. Closing is like wiping the slate clean for temporary accounts, so the new period can start fresh. Revenues, expenses, dividends, all zeroed out, ready to capture the story of the next chapter. It's just like a scoreboard at the end of a game. You tally the points, declare the result, and then reset it to zero before the next match begins. Permanent accounts, assets, liabilities, equity remain, but performance measures get a brand new start. Together, adjustments and closings form the bridge between daily transactions and the big financial reports that investors, managers, and regulators depend on. Adjustments ensure accuracy, closings ensure clarity and comparability across time. Without them, there would be no way to trust what the financial statements are telling us. And here's the exciting part. Now that we've tuned the instrument with adjustments and reset the scoreboard with closings, we're ready for the spotlight moment, preparing the actual financial statements. This is where all the work comes together to tell the story of a business, its performance, its financial health, and its future potential. We've come a long way. We started with transactions, the little building blocks of accounting. We recorded them. We adjusted them. We closed the books, and now we've arrived at the part that everyone actually wants to see. This is where all of that work finally comes together into something polished and meaningful. The financial statements. Think of them as the final report cards of a business, the documents that translate pages of numbers into a clear story. Financial statements are formal reports. They don't just sit in the background, they are the main stage. They show how the business performed during a period and where it stands financially at a specific point in time. Every serious decision about a company, whether it's an investor deciding to buy shares, a bank deciding to approve a loan, or managers planning the next step, relies on these statements. They are the universal language of business. And here's the key idea I want you to keep in mind as we move forward. One business, 4 financial statements, one story told in 4 different ways. Each statement has its own perspective, its own purpose, but together, they link into one complete picture. By the end of this session, you'll see exactly how they connect, how numbers flow from one to the other, and how they make the invisible story of a business visible. Let's begin with the very first financial statement that almost everyone looks at first, the income statement. Think of the income statement as the story of performance. Instead of showing what a company owns or owes at one single moment, it shows how the company did over a period of time, whether that's a month, a quarter, or a full year. In its simplest form, it answers one powerful question. Did the business make money, or did it lose money? The structure is actually pretty straightforward. We start with revenues, the money earned from selling products or providing services. For a coffee shop, that's every dollar collected from selling cups of coffee, pastries, or maybe even t-shirts with the shop's logo. Next, we subtract expenses, the costs of running the business. This includes salaries paid to employees, rent for the shop space, utilities like electricity and water, the cost of coffee beans, even the gradual expense of the coffee machine through depreciation. Every cost that was necessary to earn that revenue shows up here. And after revenues and expenses are compared, we land at the bottom line, net income if revenues are greater than expenses, or net loss if expenses outweigh revenues. That bottom line is why people often just call this the profit and loss statement. Let's make it concrete with an example. Imagine our coffee shop earns $10,000 from sales in 1 month. But during that month, it pays $7,000 in expenses. Salaries, rent, beans, and other costs. What's left? $3,000 of net income. That $3,000 is the reward for taking the risk of running the business. Now, here's an important concept students often get confused about: the difference between cash basis and accrual basis accounting. Under cash basis, you record revenue only when cash comes in, and expenses only when cash is paid out. But in the real world, most companies use accrual accounting. That means revenue is recognized when it's earned, not just when the money shows up, and expenses are recorded when they're incurred, even if you haven't paid the bill yet. So if a coffee shop delivers catering on the 29th of the month, but doesn't get paid until the 5th of the next month, that revenue still belongs in the current month's income statement. Accrual accounting makes the story much more accurate. There's also something called the multi-step income statement, which gives a more detailed breakdown. It doesn't just jump from revenues to expenses. Instead, it first shows gross profit. That's revenue minus the direct cost of goods sold. For a coffee shop, that's sales minus the cost of beans, milk, sugar, cups, and so on. Then we subtract operating expenses like rent and salaries to get operating income. And finally, after considering taxes and interest, we arrive at net income. This format makes it easier to see exactly where money is being made or lost. And if you're looking at a large publicly traded company, there's one more detail you'll always find at the bottom: earnings per share, or EPS. It tells investors how much profit is earned for each share of stock. For example, if a company makes $1 million in net income and has 500,000 shares, that's $2 of earnings per share. This number is critical for stock market analysis, and regulators require it on every public company's income statement. So, to sum it up, the income statement is the performance report. It's the scoreboard that shows whether the company's hard work over the period actually turned into a win, a loss, or something in between. Now that we've seen how the income statement tells the story of performance over time, let's turn to another essential report: the balance sheet. The balance sheet is like a snapshot, a picture of the company's financial position at a single point in time. If the income statement is the movie showing how the business performed during the month or the year, the balance sheet is the photograph that freezes one specific day. And right at the heart of it lies the accounting equation you already know: assets equals liabilities plus equity. So what exactly do we see on a balance sheet? It's divided into three main sections. First, assets: the resources the company owns that have value and can help generate future benefits. We split them into two groups: current assets and non-current assets. Current assets are things you expect to turn into cash, sell, or use up within 1 year, like cash itself, accounts receivable, and inventory. Non-current assets are the long-term items that help you run the business for years to come, like equipment, land, and long-term investments. Next, we list the company's liabilities, everything the company owes. Just like assets, liabilities are broken into current and long-term. Current liabilities are debts that must be paid within 1 year, like accounts payable or short-term loans. Long-term liabilities are obligations that stretch beyond 1 year, such as bonds payable, mortgages, or other big loans. And finally, we get to equity, the owner's claim on the business. This usually includes things like common stock, which represents the money invested by owners or shareholders, and retained earnings, which is the accumulation of profits that the business has kept instead of paying out as dividends. Here's the magic: when you add liabilities and equity together, they must always equal total assets. That's why it's called a balance sheet, because it always balances. Let's make this real with our coffee shop example. Imagine that, on December 31st, the shop has $15,000 worth of assets. Maybe that's made up of $6,000 in cash, $1,000 in inventory, and $8,000 in equipment. On the other side, the shop owes $5,000 to the bank in the form of a loan. That's the liability. What's left belongs to the owner, $10,000 in equity. And notice how perfectly it balances. Assets $15,000, liabilities $5,000 plus equity $10,000. Now, there are a couple of key ideas to remember. One is current versus non-current. Why do we separate them? Because it helps us measure liquidity, how easily a company can cover its short-term obligations with assets that are quickly available. If a company has plenty of cash and receivables compared to its current debts, that's a healthy sign. Another important format is the classified balance sheet. This is just a more organized version where we neatly group assets and liabilities into current and non-current categories. It's the standard format for most financial reporting. And beyond organization, the balance sheet provides powerful insight into two big questions: solvency and liquidity. Liquidity asks, can the company pay its bills in the short term? Solvency asks, can the company survive in the long term? By comparing what the business owns to what it owes, investors and creditors can immediately gauge financial health. So in short, the balance sheet is the snapshot. It shows what the company owns, what it owes, and what's left over for the owners, all captured in one clear picture. Now that we've covered the income statement and the balance sheet, there's one small but incredibly important bridge between them: the statement of retained earnings. Think of this statement as a kind of running total of the profits that the business has decided to keep rather than distribute to its owners. Every period, a company earns income, and it has two choices: either reinvest that profit back into the business or pay some of it out as dividends. The statement of retained earnings is where we track exactly how much is kept versus how much is given back. Here's the simple formula you'll always see: beginning retained earnings plus net income minus dividends equals ending retained earnings. Let's put numbers to it with our coffee shop. Suppose at the start of the year, the shop already had $5,000 sitting in retained earnings from previous years. During this year, it earned a net income of $3,000. That brings the total to $8,000. But let's say the owner decided to take $1,000 out as a dividend. That reduces the retained earnings, leaving an ending balance of $7,000. And that $7,000 doesn't just sit in this statement. It flows directly into the equity section of the balance sheet. That's why this report is often called the linking statement. It connects the story told by the income statement, how much profit was earned, with the balance sheet, where that profit ends up as part of owner's equity. The purpose of this statement is actually quite powerful. It tells us whether a business is reinvesting in its future or paying out profits to owners. For a growing coffee shop, reinvesting makes sense. Keeping more earnings to expand, buy new machines, or hire staff. For a mature company, shareholders might expect regular dividends instead. So in just a few lines, the statement of retained earnings answers a key question: what happened to the profit? Did it stay in the company, or was it distributed out? And by doing that, it gives investors, creditors, and owners a clear view of how profits are being managed. The last of the four major financial statements is the cash flow statement. If the income statement shows performance and the balance sheet shows position, then the cash flow statement shows the lifeblood of the business, the actual movement of cash in and out. Here's the definition. The cash flow statement reports all the real inflows and outflows of cash over a period of time. Unlike the income statement, which works on the accrual basis, this statement focuses purely on money in hand. Did cash actually come in? Did cash actually go out? It's divided into three clear sections. The first is operating activities, which covers the day-to-day cash generated by the core business. This is money collected from customers, minus payments to suppliers, employees, and for utilities. The second section is investing activities, which reflects buying or selling long-term assets. For example, purchasing a new espresso machine or selling a piece of equipment. And the third is financing activities, which includes cash flows between the company and its owners or creditors, borrowing from the bank, issuing shares to investors, or paying dividends. Those all show up here. Let's bring it back to our coffee shop example. Suppose during the month, the shop collects $2,500 cash from customers after paying suppliers and staff. That's positive cash from operations. Then the owner invests in a new espresso machine, paying $1,000 in cash. That's shown in investing activities as an outflow. To help finance expansion, the shop also borrows $500 from the bank. That's a financing inflow. Add it all up, and the net increase in cash for the period is $2,000. Now here's the key insight. Profit is not the same thing as cash. A business can show a healthy profit on its income statement, but if customers haven't actually paid yet, the cash might not be there. That's why many businesses that look profitable on paper can still run into cash flow problems. They might struggle to pay bills, salaries, or loans, even while showing net income. For investors and creditors, this statement is often the most important one. They want to see whether the company actually generates enough cash to sustain itself, pay back debt, and return value to shareholders. In other words, the cash flow statement answers the ultimate survival question. Does this business have enough cash to keep going? Now that we've explored each financial statement individually, let's pull them together into one big picture. Think of it like a story told in 4 chapters. Each statement plays a part, but together they create one continuous narrative about the business. Let's use our coffee shop as the example. We'll start with the income statement. For the month, the shop reports total revenues of $10,000, total expenses of $7,000, leaving a net income of $3,000. That's the bottom line. The shop earned $3,000 in profit. But what happens to that profit? That leads us directly to the statement of retained earnings. The coffee shop began the month with $5,000 in retained earnings. We add the $3,000 net income, then subtract $1,000 paid out in dividends to the owner. That leaves an ending retained earnings balance of $7,000. This is profit the business kept to reinvest or to strengthen its financial position. Next, we take that updated retained earnings figure and carry it over to the balance sheet. On the equity side, retained earnings now show $7,000, which forms part of total equity of $10,000. Add liabilities of $5,000, and together we get total assets of $15,000. The balance sheet is still perfectly balanced. Assets equal liabilities plus equity. Finally, let's look at the cash flow statement. While the income statement showed a profit of $3,000, the cash flow statement explains how cash actually moved. The shop collected $2,500 from customers after expenses, invested $1,000 in a new espresso machine, and borrowed $500 from the bank. Altogether, cash increased by $2,000 during the month. Now here's the key insight. These are not 4 separate stories. They're 4 connected chapters of the same story. You can start with net income on the income statement, trace it into retained earnings, see it reflected in the equity section of the balance sheet, and finally, watch the real cash movements explained on the cash flow statement. When you look at them side by side, the flow becomes clear. Performance feeds into equity, equity anchors the balance sheet, and the cash flow statement reveals the true liquidity behind it all. Together, the 4 statements provide a complete, reliable picture of how the business is doing, not just in theory, but in reality. So let's step back and see the full picture. Each financial statement has its own role, but together they give us a complete understanding of a business. The income statement shows profitability. Did the company actually make money during the period? The statement of retained earnings reveals how those profits are being used, whether they're being reinvested into the business or distributed as dividends. The balance sheet provides a snapshot of financial position. What the business owns, what it owes, and what's left for the owners at that exact point in time. And the cash flow statement uncovers real liquidity, the actual cash coming in and going out, which tells us if the company can pay its bills and survive day to day. Here's a way to make it stick. Imagine the business as a person. The income statement is like their report card, showing how well they performed. The balance sheet is their health check, showing their current condition. The retained earnings statement is their savings account, tracking what's been kept aside. And the cash flow statement? That's their wallet, the money they actually have in hand to spend. When you put all 4 together, you don't just see numbers. You see a living story of performance, financial strength, and survival. And now comes the exciting part, because preparing the statements is only the beginning. The real insight comes when we learn how to analyze them, looking at ratios, spotting trends, and uncovering the story behind the numbers. That's where accounting transforms from record-keeping into decision-making. And that's exactly where we're headed next. Up until now, we've been looking at a business like a coffee shop that provides mostly services and sells drinks customers consume immediately. But not all businesses are service companies. Many businesses are what we call merchandising companies. They buy products, hold them as inventory, and then resell them at a profit. Think of clothing stores, grocery stores, or even our coffee shop if it starts selling packaged snacks or branded mugs. So here's the big difference. Service companies earn revenue by performing services. They don't carry inventory. Merchandising companies earn revenue by selling goods, and because of that, they must track inventory and cost of goods sold, or COGS for short. Now let's pause on COGS because this is a central idea. The formula is simple. Beginning inventory plus purchases, ending inventory equals cost of goods sold. What this tells us is you start with the stock you already had at the beginning of the period. Add the new goods you bought during the period, subtract what's left unsold at the end. What's left is the cost of what you actually sold, your COGS. This matters because in a merchandising business, net income isn't just revenue, expenses anymore. It's actually sales, cost of goods sold equals gross profit, and then you subtract operating expenses to get net income. Now let's zoom in on inventory systems, because businesses have two main ways of keeping track. Perpetual system. Every time an item is bought or sold, inventory and COGS are updated instantly. Imagine scanning items at a grocery checkout. The system knows exactly what's left on the shelves. Periodic system. Instead of updating continuously, you only count inventory at the end of the period and then calculate COGS. Smaller shops or businesses without complex tech often use this. So which is better? The perpetual system gives real-time accuracy, but it's more expensive. Periodic is simpler, but less precise until the end of period count. Let's bring this back to our coffee shop. Suppose we decide to sell packaged muffins and bottled juices alongside coffee. That means we now have inventory. At the start of the week, we buy 100 muffins for $200. At the end of the week, 20 are still unsold, worth $40. That means our COGS is $160. When we sell the muffins, our financial statements will now show two things: sales revenue for the muffins sold, COGS for the muffins consumed. And the difference between the two is our gross profit from those sales. So the big takeaway is this: merchandising businesses introduce a new layer, inventory and COGS, and the system you use, perpetual or periodic, decides how you keep track. But no matter what, the end goal is the same: to measure gross profit, the real money made from buying and selling goods. All right, now let's move into one of the most important building blocks of accounting: assets and depreciation. Think of a business like a toolbox. Assets are the tools inside that toolbox. Some tools are small and used up quickly, like a pencil or notebook. Those are your current assets. Others are big, heavy tools, like a coffee machine, delivery van, or the building itself. And those are your non-current assets. Both matter, but they behave very differently in accounting. So let's start with the distinction. Current assets are cash and other resources that the company expects to turn into cash, sell, or use up within 1 year. That includes cash, accounts receivable, and inventory. If our coffee shop sells a latte today and the customer pays cash, that cash is a current asset. If the customer pays with a tab to be settled next week, that's accounts receivable, still a current asset because we expect to collect soon. Non-current assets, also called long-term assets, are things the business holds for many years to help generate revenue. Think of equipment, vehicles, land, or long-term investments. A coffee machine is a non-current asset because it helps us serve customers for years, not just for 1 week. Now, here's where accounting takes a smart turn. Imagine you buy that coffee machine for $10,000. If we simply expense the entire $10,000 on the day we bought it, our income statement would look awful in month 1. One giant expense, and then show nothing in the following years, even though the machine keeps helping us earn money. That doesn't reflect reality. Instead, accounting uses a process called depreciation. Depreciation spreads the cost of a long-term asset over the years it's used, so expenses are matched with revenues. That way, financial statements reflect not just what you spent, but how that spending helped you earn income across time. Now let's dive into the methods. The most common is the straight line method. It's simple. Take the cost, subtract any salvage value, that's the estimated leftover value when you're done with it, and spread the rest evenly over the useful life. So, our $10,000 machine, no salvage, useful for 5 years, $2,000 each year. Nice and predictable. This method is so widely used because it's easy and matches many real-life cases where assets provide equal benefit year after year. Then there's the double declining balance method, which is an example of accelerated depreciation. Instead of spreading costs evenly, this method records more expense in the early years and less in later years. Why? Because many assets lose their usefulness or efficiency faster in the beginning. Think about your smartphone. The first 2 years it works great, but after that, the battery drains faster and the performance drops. Accounting recognizes that reality by front-loading the expense. A third method is the units of production method. This ties depreciation to actual usage instead of just time. So if our espresso machine makes 60,000 cups of coffee in its life, and in year 1 we brew 12,000 cups, then we expense 12,000 divided by 60,000 equals 20% of the cost that year. The more you use it, the faster it depreciates. This method is great for factories or equipment where wear and tear depends directly on use. So far, so good, but depreciation isn't just about expense. It also introduces a new account called accumulated depreciation. Here's how it works. Every time we record depreciation, we debit depreciation expense and credit accumulated depreciation. Over time, accumulated depreciation grows as more expense is recorded. On the balance sheet, you'll see the asset's original cost, say $10,000, and right underneath, accumulated depreciation, maybe $2,000 after the first year. Subtract one from the other, and you get book value, also called carrying value. And here's something critical. Book value is not the same as market value. If you bought a coffee machine for $10,000, and after 2 years the book value is $6,000, that doesn't mean you can sell it for $6,000. Market value could be higher or lower depending on demand. Book value is purely an accounting measure, original cost minus accumulated depreciation. Why do we care about all this detail? Because depreciation impacts both the income statement and the balance sheet. It reduces reported profits each year, while also reducing the reported value of assets. That means businesses, investors, and even tax authorities watch depreciation closely. It's also why there are different methods. Each one tells a slightly different story about how an asset's cost is consumed. Let's pause for a real-life connection. Imagine 2 coffee shops, both buying the same $10,000 espresso machine. Shop A uses straight-line depreciation, so they record $2,000 expense each year. Shop B uses double declining balance, so they record maybe $4,000 in year 1, $2,400 in year 2, then smaller amounts later. Both are correct under accounting rules. But look what happens. Shop A's profits stay steady, Shop B's profits look lower at first, then higher later. Same machine, different methods, different financial picture. This is why investors always check which depreciation method a company uses. Now let's go a little deeper. Why do we even separate current and non-current assets? It's all about liquidity. Current assets are liquid. They can be converted into cash quickly to pay bills. Non-current assets are valuable, but they're not liquid. You can't sell your factory building overnight to cover payroll. By dividing assets into current and non-current, financial statements give readers insight into both short-term flexibility and long-term strength. One more important note. Not every long-term asset depreciates. Land, for example, is never depreciated because it doesn't wear out or lose usefulness with time. In fact, land can even appreciate. So on the books, land always stays at its original cost, no matter how much its market value changes. That's a little accounting quirk worth remembering. Now that we've mastered assets, let's shift to the other side of the balance sheet, liabilities and equity. If assets show what the business owns, then liabilities and equity show who has a claim on those assets. Think of it like a house. If you buy a house with a mortgage, the house itself is the asset, but the bank holds a claim until you pay off the loan. The portion you truly own is your equity. Same idea with businesses. Let's start with liabilities. Liabilities are what the business owes to outsiders. Promises to pay cash, deliver goods, or provide services in the future. They're the obligations that balance against the resources we hold. Current liabilities are short-term obligations due within 1 year. These include accounts payable, like when our coffee shop buys beans on credit and pays the supplier next month, or wages payable when employees have earned pay but haven't been paid yet, or short-term loans like a 6-month bank loan. Current liabilities are the bills knocking on your door soon. Long-term liabilities are obligations due after 1 year. Examples include bonds payable, long-term bank loans, or mortgages. These are the heavy, long-term commitments of the business. Here's a simple way to remember. Current liabilities equals right now pressure. Long-term liabilities equals later pressure. Both matter, but investors often watch current liabilities closely to see if the company can handle its short-term commitments. Now, let's move to equity. Equity is the owner's claim after liabilities are paid. It answers the question, after we settle all debts, how much of the business belongs to the owners? The structure of equity depends on the type of business. For a sole proprietorship, it's simple. One owner, one equity account, often called owner's capital. Profits go in, withdrawals come out. In a partnership, each partner has their own capital account. That way, ownership shares, contributions, and withdrawals can be tracked separately. In a corporation, equity becomes more complex because ownership is divided into shares of stock. Shareholders own part of the company through these shares. That's where concepts like common stock, preferred stock, retained earnings, and additional paid-in capital come in. Let's zoom in on issuing shares, since this is where new students often get tripped up. When a corporation issues stock, it assigns a par value, a nominal, often very small value per share, sometimes just $1 or even 1 cent. This is not market value, it's just a legal accounting figure. So if our coffee shop incorporated and issued 1,000 shares, with a par value of $1 each, the company would record $1,000 as common stock. But suppose investors actually paid $10 per share. That's $10,000 total received. The difference, $9,000, is recorded as additional paid-in capital, APIC. Together, common stock as APIC reflect the capital that shareholders contributed to the business. Now, once a company is up and running, profits begin to build up in equity. But here comes the big question. Do we keep the profits or return some to owners? That's where dividends come in. A cash dividend is straightforward. The company pays cash out of profits to shareholders. For example, if our coffee shop had $3,000 in profit and decided to pay $1,000 as dividends, the owners get cash, but the retained earnings decrease by $1,000. A stock dividend works differently. Instead of paying cash, the company issues additional shares to existing shareholders. Nobody receives actual money, but ownership is spread across more shares. Stock dividends keep cash inside the company while still rewarding owners. So dividends are basically a choice. Reward owners with cash now, or reinvest profits for future growth. Now, one more concept that often surprises beginners: treasury stock. Treasury stock represents the company's own shares that it previously issued but later repurchased from shareholders. Imagine our coffee shop sold 1,000 shares but later bought back 100 of them. Those 100 shares are held in treasury. They're not considered outstanding anymore. Why would a company buy back its own stock? Several reasons. To increase the value of remaining shares, to have shares available for employee stock plans, or simply because management believes the stock is undervalued. Importantly, treasury stock reduces total equity. It's recorded as a negative in the equity section of the balance sheet. So to recap the whole picture, liabilities are what we owe to outsiders, equity is what belongs to the owners. In corporations, equity gets more complex with stock, APIC, retained earnings, dividends, and treasury stock. And just like with assets, the way these are presented tells a deeper story about the company's financial health. Let's ground this with our coffee shop one last time. Suppose the shop has $15,000 in assets. It owes $5,000 in loans and accounts payable. Those are liabilities. That leaves $10,000 in equity. Within that $10,000, maybe $3,000 is from issuing shares, $7,000 is retained earnings, and last year the company bought back $500 worth of its own stock. So treasury stock shows as minus $500. That breakdown helps investors see not just the total equity, but where it comes from. And here's the big takeaway. When you look at the balance sheet, don't just focus on assets. Always ask, who financed these assets? Was it creditors through liabilities or owners through equity? The answer tells you a lot about risk, control, and long-term sustainability. That's liabilities and equity, the obligations we must meet and the ownership that remains. Together, they explain not only who holds claims on the business, but also how the company funds its operations and growth. Now walk through transactions, adjustments, closing, and the financial statements themselves. But let me ask you this. What's the point of all those numbers if we don't actually use them? Accounting isn't just about recording history. It's about turning numbers into insight, so managers, investors, and creditors can make smarter decisions. That's where financial analysis comes in. Think of it like this. The financial statements are like the medical tests of a business. Balance sheet, income statement, cash flows. But analysis is the doctor interpreting those results. Without analysis, the numbers don't tell us much. With analysis, we start to see the story behind them. Let's keep it simple and focus on 3 powerful ratios every beginner should know. First is the current ratio. It's a measure of liquidity, the company's ability to pay short-term obligations. The formula is simple. Current ratio equals current assets divided by current liabilities. If our coffee shop has $8,000 in current assets, cash, receivables, inventory, and $4,000 in current liabilities, the current ratio is 2.0. That means we have $2 of short-term resources for every $1 we owe soon. A healthy sign. But if the ratio is below 1, it suggests the company might struggle to meet its immediate bills. Next, the debt-to-equity ratio. This tells us about leverage, how much the company relies on borrowed money compared to owner's money. The formula is debt-to-equity equals total liabilities divided by total equity. Suppose our coffee shop has $5,000 in liabilities and $10,000 in equity. Debt to equity equals 0.5. That means creditors have half as much invested as owners, fairly conservative. But if debt to equity climbs to 2 or 3, it means the company is heavily financed by debt. More risk, but also potentially higher returns if things go well. Investors pay close attention here because too much debt can sink a business when times get tough. And finally, return on equity, or ROE. This measures profitability from the owner's perspective. Formula: ROE equals net income divided by average equity. If our coffee shop earned $3,000 this year and average equity was $10,000, ROE equals 30%. That means owners earned a 30% return on their invested capital. Very strong. ROE helps investors compare different businesses. It answers, how effectively is this company using the owner's money to generate profit? So in short, current ratio equals can we pay our bills? Debt to equity equals how much risk are we taking on? ROE, are owners getting a good return? Notice how each ratio pulls from different statements. Current ratio comes from the balance sheet. Debt to equity combines liabilities and equity, also on the balance sheet. ROE connects the income statement's net income with equity from the balance sheet. This is why all the statements work together. They're different pieces of one puzzle. And here's the final thought. Accounting doesn't end with preparing the statements. It ends with decision-making. Whether you're a manager deciding if you can afford to expand, a lender deciding whether to give a loan, or an investor deciding whether to buy shares, Analysis is the bridge between raw numbers and smart choices. So as we wrap up this section, remember, recording is the foundation, reporting is the story, but analysis is the insight. That's where accounting comes alive, helping people make better, smarter, more confident decisions. By the way, don't forget to check the links in the description. I've put together some extra resources there that will really help you understand accounting even faster and apply it in real life. And the best part? There's also a free guide waiting for you, so make sure you grab that before you move on.